From New York City for our viewers worldwide, I'm Jonathan Ferro with 30 minutes dedicated to fixed income. This is Bloomberg Real Yield. Coming up, the world's biggest central bank is convened in Jackson Hole. Investors brace for a speech from ECB President Mario Draghi. Chair Yellen sidesteps the monetary policy debate and offers a broad defense of post-crisis finance rules. And the Treasury bill market adjusts to heightened concerns over the U.S. debt ceiling. We begin with the big issue. Why in Jackson Hole? It's less about Yellen and maybe more about Draghi.
I'll be paying more attention to Mario Draghi.
Investors should be paying more attention to Draghi than to Yellen.
He was walking on eggshells.
Everything, again, is so data dependent. Obviously, if the Eurozone was to show any signs of rolling over, core inflation drifts back down, it may be very difficult for them to announce anything at all. But certainly the market is looking for some clarity.
The central bankers will want to be very gradual, very careful in both signaling and implementing the withdrawal of this extraordinary accommodation that they've put in place over the last few years.
And how do you exit in a careful way where you don't signal too much that you're exiting and where you still give time for the economy to do well and you still give time for inflation to come up? And I think that he will, at Jackson Hole, go also very, very carefully forward.
The economy there is more fragile than the U.S. from a structural perspective. So I think the Draghi comments are going to have much more information content at this stage.
The ECB wants to always say, we're always going to say nothing, we're always going to leave our options open, but the market's going to hear what it wants to hear. And it's kind of backing off a little bit on the idea that he's going to say something. But it could always interpret what he says is in a more hawkish tune. So we'll just have to wait and see what he says.
Let's get straight out to Jackson Hole, Wyoming, shall we, and bring in Bloomberg's very own Alessandro Speciale. Alessandro, great to have you with us on the programme. What are the questions that we're looking for answers to when we get that speech from President Mario Draghi?
Well, what everyone would want to hear from Draghi is some clarity about how the ECB will continue or will exit in the course of 2018 from its unconventional monetary policy, most notably large asset purchases. But this is most likely not going to happen. The ECB Governing Council is going to meet in September, and most likely Draghi won't want to front-run the discussion that the governors are going to have at that time.
Alessandro, it hasn't stopped him before. He's boxed in the Governing Council before. He did this 3 years ago at Jackson Hole. Why is this time different, and why is the topic so much more sensitive about removing accommodation?
Well, that's very simple. That's because at the time in 2014, Draghi probably felt that he needed to jolt the Governing Council into action in what he felt was a rapidly changing, almost emergency situation where the euro area was slowly sliding towards deflation. Right now, the euro area economy is doing well. Growth has been surprising on the upside. There is not so much inflation, but at least there are timid signs that it may be picking up in the next 2 years. So there is no need to rush, no need to jolt the Governing Council into action.
Well, he's going to get a nice break in the beautiful Jackson Hole. Bloomberg's Alessandro Speciale from Jackson Hole, Wyoming. Thank you very much, sir. I want to bring in the roundtable for the next 25 minutes. With me in New York is Martin Hegarty, head of inflation-linked bond portfolios at BlackRock. Ira Jersey, U.S. interest rate strategist here at Bloomberg Intelligence. And coming to us from Atlanta is Matt Tom, CIO of fixed income at Voya Investment Management. Ira, let's begin with you. The theme is fostering a dynamic global economy. It's not really the setting for an ECB president, or at least it shouldn't be the setting for an ECB president to go out there and intervene in the currency market and do anything spectacular along those lines.
Very unlikely. I think what Mario Draghi, wants to do is probably play with some of the themes that have been talked about that this conference is going to focus on. It's going to be things like regulation. Are there things that either central banks or governments can do to stimulate the economy? I mean, Janet Yellen took a little bit of a step back, even though she was pretty pro-regulation this morning. She also said, hey, there are tweaks that could probably be done because the interrelationships of all of these different regulations might actually be hampering growth, and maybe we should look into that. And I think Mario Draghi might come from the same type of approach.
Martin, for investors, how are you meant to prepare for the removal of accommodation in Europe when central bank activity has been so big over the last few years? And you've seen what's happened to markets in Europe, tighter spreads, creditors driven higher, yields have been compressed. How are you meant to prepare for the removal of any of that stuff?
That's a great question, and I wouldn't say it's specific to Europe. I think it should be applied globally, where you've still got the Fed with a tremendous balance sheet. You've got the BOJ continuing to manipulate rates between +10 and -10 in the 10-year space. And the impact that it's had globally by taking yield and duration out of the market is catastrophic, where you've had this grab for yield, where the lack of availability of assets in Europe has bled into demand for US assets, and the same can be said for Japan, leading to global demand. So the way to prepare for it is obviously we hang on every word that central bankers say. They have been manipulating rates and currency markets via interest rates for the last few years. And they learned a lesson during the taper tantrum that you have to approach this incredibly carefully.
Europe is so different though, and Matt Toms, I want to bring you into the conversation. Europe's different in the sense that they've been buying corporate bonds as well, and I've put up the chart on my Bloomberg, and you can see the Bloomberg Barclays corporate index in Europe, both high yield and investment grade, and spreads are so tight, Matt. What's going to happen when the ECB tries to step back to that chart?
Well, ultimately, there is a headwind coming, but we think it's going to be some time away. We don't think 9 o'clock German time tonight's the right time for Draghi to start messaging a tapering, particularly for the currency markets, which will still be quite liquid in U.S. time. Ultimately, there is a headwinds of spread, but we think that's more of a mid-2018 story and not a 17 story.
Ira, what's interesting is we've talked about the Federal Reserve winding down QE. Yields are lower now on 10-year treasuries than they were when they were running QE at 80 billion a month. So I asked the question, could we have the same situation? Because pretty much every conversation around the ECB is based around, well, yields have got to go higher when they pull back. But could we have a similar situation in Europe that ultimately we've got here in the United States?
Well, I think not so much when they start to taper or when taper's announced. I mean,
sure.
we know that once they announce taper, the markets are going to reprice and say, okay, they're not buying quite as many bonds. And then the market's going to then ask a secondary question, which is, okay, now that yields are somewhat higher, what's the path of inflation and growth? And, you know, if that's stable, then maybe rates stabilize there. But if people say, well, maybe this is a mistake, they're going too fast, they're going to unwind too fast, that's going to wind up making longer-term rates in particular come down. And you can wind up seeing things like, you know, linkers, for example, wind up showing break-evens coming in quite substantially in that scenario.
Matt, we spend so much time stock versus flow, and we spend a lot of time thinking about flow and focusing on flow as investors look at the rate of QE. But the balance sheet's massive now. How important is that balance sheet going to be, and how powerful will it be in the years to come over at the ECB?
We think all balance sheets are going to shrink slowly. The Fed has put out a very slow pace of $1 trillion over 3 years decline. The ECB will likely follow pace when they eventually announce this. So it's going to take, by all measures, it looks like multiple years, probably 5-10 years, to get these balance sheets lower. And there's really an echo fear of the taper tantrum. We think global central banks are very afraid to do anything quickly. Actually, we'd say that they're missing too slowly. And the surprise in 2018 may be the increasing pace of the Fed, potentially under a new leader, and then ultimately, eventually, an acceleration of any policy ultimately announced by the ECB.
We'll get to the Federal Reserve conversation in just a moment, but just comparing the experience of the balance sheet and the power of the balance sheet at the Fed versus the power of the balance sheet at the ECB, that stock versus flow story, that debate. Where do you stand on that, Ira?
Well, so I think flow winds up mattering significantly more when flow is what's driving prices, and that's what's driving prices right now. The stock effect, I think, has a much longer term kind of balancing effect, whereas you say, okay, should yields be 2% or 4%, right? That winds up being a different scenario. You know, one of the things that I'd like to say about, you know, any balance sheet is what the ECB is doing is significantly different than what the Fed did, because, you know, the Federal Reserve for most of QE didn't buy significantly risky assets like the ECB is doing. The ECB buying corporates, like you mentioned before and showed that chart, you know, they're really compressing corporate yields and corporate spreads. That dynamic can change a lot. And that's happened already in the U.S. too, which I'm sure we'll get to.
Well, Martin, the removal of accommodation, the experience of the Federal Reserve was a plan for how you go from X to 0 in a period of time determined by the Federal Reserve. For the ECB, the next plan for QE, will it be like that? Will it be this is how we get to 0? Or will it be the case of this is us going from 60 to 40 and this is how long we'll do it for and we'll revisit it in X amount of time?
I think your latter option is how they're going to proceed, where, you know, as things currently stand, their current program, they're going to start running into some technical difficulties in the first half of 2018 with respect to issue ownership of bonds, etc., relative to outstanding. So I do think what they're going to do is put up short-term goals where they're going to try and get to. There is some political risk again on the horizon, starting with Italy, which I do think the ECB will still like to be engaged in a QE program as we approach some sort of Italian election in 2018.
Martin Hegarty from BlackRock sticking with us alongside Ira Jersey from Bloomberg Intelligence here in New York, and over in Atlanta, Matt Toms of Voya Investment Management. Coming up on the program, Fed Chair Janet Yellen has potentially made her final speech at Jackson Hole. We'll get into that in just a moment. From New York, you're watching Bloomberg Real Yield. Jonathan Ferro from New York. For our viewers worldwide, this is Bloomberg Real Yield. Federal Reserve Chair Janet Yellen said today at Jackson Hole that any rollback of post-crisis financial reforms should be, quote, modest, because they've made the banking system safer and more resilient without unduly diminishing the supply of credit to the economy, potentially putting her at odds with the Trump administration as a question mark hangs over her future. Still with us is Martin Hegarty from BlackRock, Ira Jersey from Bloomberg Intelligence, and Matt Toms from Voya Investment Management. Martin, why did we get a bit of a bid, and I put the emphasis on a bit, after this speech in the Treasury market?
Sure. The bar for Yellen's speech was pretty low, where there was very little expected to come out of it, and she definitely did not disappoint, where there was potentially some small hope that she may bring in current level of financial conditions and how that may play into monetary policy, but she barely brushed on the topic and talked predominantly about regulation, as you referred to. And we've had a couple of a basis point rally on the front end of the curve. 10-year yields are a couple of basis points lower, and the dollar is weaker. Well,
Matt Toms, let's talk about that financial condition story and that tension between loose financial conditions, potentially elevated market pricing, between that and ultimately soft inflation print after soft inflation print after soft inflation print. How is the Fed meant to calibrate monetary policy for those two things?
Right. Now, we think that the Fed's going to increasingly bifurcate those two things, and inflation will be drawn into the rate-setting debate, and the balance sheet size is more likely to be drawn into the financial conditions debate, and also the bubbling Fed statements about asset value. So we think that ultimately the balance sheet is likely to be the topic of conversation on the front burner going forward, and ultimately with the potential new Fed chairman, after Yellen's pretty open disagreement with the administration policy on bank regulation, we have to anticipate a new chairman will move towards balance sheet.
Well, Matt, let's talk about that. You took us there. Was that the nail in the coffin for you, the idea that the Fed chair is standing up for the current regulatory system, the structures, and this is ultimately, whether she's a low rates person or not, this is ultimately what this administration wants, deregulation?
Yeah, it seemed like the delivery of the 2-week notice in corporate terms, and it seems that it's pretty clearly at odds, and we would expect that this is the beginning of we'll hear messaging about the change to ultimately likely cone.
Ira, did she just sign a resignation letter with this?
Yeah, I agree with that assessment. I don't think that there was a very high percentage that she was going to get reappointed anyway, or that if she would say yes, if she would agree to it.
Yeah.
So I do think that we'll probably get someone, and someone might look, even if it's not Gary Cohn himself, it'll be someone who looks like him, probably a monetary policy dove, generally dovish, but also anti-regulation. So I think that's the type of person that the Trump administration is likely to appoint.
Whether it's Gary Cohn or not, an interview with the Financial Times, a suggestion that they're hopeful of getting tax reform done before the end of the year. You add the deregulatory story onto that as well. Is that going to be a stimulus for this economy? The hopes coming into the year was that break-evens would roll higher, yields would go higher, everything was going to be great, we were finally going to get that inflation. Break-evens have rolled over, yields are at 220 on a 10-year. When's that going to change, Martin?
Well, you guys have referred to the current year-over-year run rate of inflation, which took a meaningful dip over the last 5 months. And I think some of it is legitimate and some of it is statistical noise in certain components. when we look at the legitimate components, where is that low/disinflation coming from? And it's not coming from areas that are disadvantaged to consumers. We're getting, discounting in apparel as we have the internet effect. You've had a significant reduction in wireless and telecommunications plans, which are not a sign of lack of demand. They're all a sign of sort of recalibration of supply delivery techniques, and that is definitely a pickup in real disposable income to consumers.
mean, in a way, it's like the new productivity boom ends up being lower prices, right? And we had
Amazon, Whole Foods.
Yeah, all of these things are basically productivity, but not in worker productivity, but in corporate productivity, and it just means that you can have lower prices and not. So what does that mean for things like financial conditions? Financial conditions can remain very accommodative even with the Fed starting to hike, because you basically have a productivity miracle that's not showing up in traditional productivity measures.
Matt Toms, you saw that picture, that video of the walk between Chair Yellen, President Draghi and Governor Kuroda. When you look at the inflation picture in those individual regions, the inflation picture is not terrific in Japan, that's for sure. The inflation picture in the United States rolling over, in the Eurozone to some extent rolling over as well. And I just wonder, when we have a conversation on Wall Street, that chart is seen as a bad thing. If you showed that to anyone and explained it to someone on Main Street, they'd say, that's okay, I want lower prices. Why is that chart viewed over at the Federal Reserve, the ECB and the Bank of Japan as a bad thing, Matt? Why ultimately is that a bad thing?
Well, it's ultimately the fear of debt deflation that's a hangover from the financial crisis, and that's to be avoided. But ultimately, we would say there's a very big difference between a lack of upside in inflation and a fear of downside. The market doesn't, in our opinion, really fear debt deflation at this point, but the central bankers are still acting as if they do. So ultimately, moderate inflation, 1.5% to 2%, is not to be feared, and it does paint a very constructive outlook for growth and financial conditions, not needing to be addressed too aggressively on the rate policy setting front.
Matt Toms from Voya Investment Management, Martin Hegarty from BlackRock and Ira Jersey from Bloomberg Intelligence. You guys are sticking with us. I want to get a check on where bonds have been this week. 2s, 10s and 30s in the Treasury market. Yields throughout the week grinding that little bit higher at the front end by 2 basis points. Rolling over on 10s and 30s by the same amount, 2 basis points. So it is a flatter curve. 10-year Treasuries down about 2 basis points to 217 on the week. Still ahead, the final spread the week ahead featuring Brexit talks and the US jobs report. Next week, September already. This is Bloomberg Real Yield. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. Coming up over the next week, we will get another round of Brexit and NAFTA talks. The UK's Prime Minister, Theresa May, will be visiting Japan, and we'll get a series of US economic reports that will include inflation, autos, and it's payrolls Friday already, believe it or not. The President of the United States will also be making a public push for overhauling taxes. Still with us is Martin Hegarty from BlackRock, Ira Jersey from Bloomberg Intelligence and Matt Toms from Voya Investment Management. Something we've got to talk about now is what is happening down in DC. Matt Toms, we've got this debate over the debt ceiling. We've got this debate over the deficit and what's going to happen with the budget going forward and tax reform, etc. A government shutdown potentially on the cards. The only tension that we've seen so far is in the Treasury bill curve, and I wonder whether it can bleed out from there and go elsewhere. What are your thoughts?
Yeah, we ultimately don't think it will bleed out. We think that a shutdown would be political suicide, and if it were to happen, it would be extremely short-lived. We don't think anybody really gains from that. And ultimately, this is likely to be noise, but ultimately, you need to move to this tax debate, and the difference between reform and tax cuts are meaningful. We think will be impacting the market very differently. So we're anxious to move beyond the debt ceiling and get to the real debate on taxes.
Ira?
Yeah, I can't wait till we're done with the debt ceiling, but unfortunately I think it's just coming. We haven't really heard a lot of the noise around it. We've been talking about it a little bit here and there in Bloomberg Intelligence and markets, but you look at the news flow, and if you look at what I have up on the Bloomberg terminal, you look at the news flow, how many mentions the debt limits had in the past versus credit default swap spreads on the U.S., and we're just in kind of the first inning here of talking about the debt ceiling. Usually it's about 2 or 3 weeks before kind of that end date, which I currently have at October 3rd on my model is when we're going to start to see this. So right around September 15th, right around the time you get these corporate taxes that come in, everyone will nail down some date that the government will default if they don't raise the debt ceiling.
Yeah.
And unfortunately, I agree I agree that I wish it would just go away and that they would just repeal it forever. And we can talk about real things like tax reform or the budget in general.
But ultimately, Martin, it won't go away. But does it matter? And we've been conditioned, investors have been conditioned to say that ultimately it doesn't, that you get through it and you move on. Is this another episode in the sense that it doesn't matter and we'll move on?
Well, I think there's a couple of things. One, you've got an English person asking a Zimbabwean about American politics.
There we go. There we go. I mean, our political situation just as messy.
But I do think it matters. And you mentioned that it's finding its way into the front end of the bill curve. I would argue that it's actually finding its way into the dollar. I do think it's finding its way into fixed income yields as a whole, as there's been this flight to quality, as the discourse in DC becomes a little bit more negative. So it's happening, and it's going to continue to be important. That being said, I do think it will be resolved, but not without a significant amount of uptick in headlines going into it.
Well, more broadly, Matt, what we have seen is a flight to quality, not just in fixed income in terms of sovereigns, but in terms of credit as well. Does this just accelerate that move? It's another reason to accelerate that move into higher quality securities, into higher quality assets.
We think it's the current symptom. The ultimate, the bigger issue is the dysfunction in Washington. So continued dysfunction in Washington beyond the debt ceiling and into tax reform or health care and the like is starting to weigh on the market. I would agree. It has an impact on the dollar and on risk-taking. But it's the bigger issue, not just the debt ceiling. When that goes away, the markets will very quickly focus on can anything actually get done. And increasingly, as people say no, there's a bit of disappointment and a rolling back of the growth outlook, unfortunately.
Guys, we're going to wrap up the program the way we usually do it, which is wrapping up the last 30 minutes and trying to look ahead with some rapid-fire questions. The first one to you all. One-word answers, please. Did Chair Yellen just kill the chance of a second term? Yes or no, Martin?
No.
Ira?
Yes.
Matt?
Absolutely.
Buy and hold 10-year treasuries or 10-year bonds to year end. Martin, bonds or treasuries?
To your end, I would take treasuries.
Ira?
I agree, treasuries.
Matt?
I'd take boons.
Payrolls next week, 180,000 the estimate. Upside or downside surprise? It's a guessing game. Martin?
Upside.
Ira?
Downside.
Matt?
Upside.
Gents, great to have you with us on the programme. Appreciate your time. Martin Hegarty from BlackRock, Ira Jersey from Bloomberg Intelligence, and Matt Toms from Voya Investment Management. That does it from us, from New York. We'll see you next Friday at 12 New York time, 5 p.m. in London. I'd hope in Hong Kong you're doing something a lot more interesting. This is Bloomberg, Real Yield.